Hey everybody, it's Brian Shannon from alphatrends.net. Today's Friday, the 11th of March, 2021. Is anyone really surprised about these results that the S&P lost 3%, the Nasdaq 4%, semis down 4%? We've got a less accommodative Fed that's likely to raise rates next week. We've got a war going on, and we've got runaway inflation. So, the odds just don't favor the long side, especially when we are in a primary downtrend. We look at I've been posting this chart on the Twitter all week and last week. And what we have here are three different time frames for the S&P 500. On top, we have the weekly, the 195 minute. There's two equal candles per day when we look at 195 minutes, and then the 15-minute time frame. And then we have that same information for the Nasdaq 100 and the Russell 2000. So let's break it down. The weekly time frame, we have been previously closing above the volume weighted average price from the beginning of January 2021, and we've touched this volume weighted average price a couple times. Looks like we're testing it again. The next level it looks like this market's likely to head down to is towards about 400 based on the weekly time frame. On the intraday time frame, that is 2 candles per minute, here's our year-to-date volume weighted average price. That's declining. We had seen previously the January 24th volume weighted average price held as resistance on that rally. So we put a volume weighted average price on the February 24th rally. It acted as support initially and then resistance once this week right here on Wednesday, and then again today. So we can see that with a little more clarity here on the shorter term time frame. Let's take a look there. You can see that this right here came almost perfectly on Wednesday's rally, and then today's almost perfectly to that level. During this entire time, look at the orange moving average. That's the 5-day moving average I always talk about. It continues to decline, so it's guilty till proven innocent. Let's just take a look at the normal layout that you're used to seeing, which is right here. And on this daily time frame for the S&P 500, we continue to be below the declining 20 and 50-day moving average. That means rallies are guilty until proven innocent. I'm not looking for a bottom. The bottom will reveal itself just like the top did much later down the road. But the action in the individual names continues to be terrible, and of course in the index as well. Don't fall for these rallies. Some of the sharpest rallies occur in downtrends. That's a fact. We had a pretty good rally from 415 to 430, a 5% rally basically right there, and 4.5, whatever it is. But the point is, it was a failed rally, and that's what happens to rallies in downtrends. They fail with a declining 5-day moving average. And again, here's our month-to-date volume-weighted average price. That's anchored right here, of course, and the volume-weighted average price from the 24th low. Those came together and provided supply. This right here is our week-to-date volume-weighted average price, which we also closed below. So this market remains guilty until proven innocent. There's no other way to look at it. Looks like we're heading for a test of another test, that is, of the volume-weighted average price from this peak. We tested it right there a couple weeks ago. Looks like we're headed for that again. Sometimes what we see is a slight undercut as it gets oversold. It takes stops out and then a rally emerges. Doesn't mean it will happen, but it's just something to be aware of. For now, again, don't waste your time looking for the bottom. It doesn't exist right now. We've been talking all year about PayPal and people who are trying to find the bottom there. Well, again, news and surprises tend to follow the direction of the trend, and that's exactly what we saw, with Rivian. This company came public at $78 per share, rallied as high as 180, and it's just been downhill from there. Declining 20-day moving average, declining 55-day moving average. They reported earnings last night, and the stock is down once again. It shouldn't be a big surprise. That is, same is true with DOCU. This is DocuSign. DocuSign has been in a horrific decline. Why would you expect it's going to rally? A trend once established is more likely to continue than reverse. You can argue till you're blue in the face that it's a good company, but it's a terrible stock. Good stocks go higher, bad and create wealth. Bad stocks cost people money. The volume weighted average price since this came public is way up here at about 145. That means the average participant who who is involved in here from the beginning of its inception, is down close to 50%. It's just a terrible destruction of wealth. You can say, well, I'm in it for the long term, but sure, wouldn't it be great to just, get out when they start breaking important levels and then, wait for it to undergo accumulation and then buy as it rallies again? If they don't scare you out, they will typically wear you out, and it's going to take a lot of time for these stocks to heal. Let's talk about the Nasdaq. It's coming down once again to the volume weighted average price from the COVID low. That is very close to being tested. As we've previously noted, this is only a 38.2% retracement. So, so far it's just a normal little pullback. If we, undercut that, maybe bounce a little bit, I would expect a lower high, and then perhaps we head down towards the 50% retracement. There's nothing here to say it can't continue lower. In fact, most signs are pointing, globally and, based on Fed policy and just the action of the stocks, that they are more likely to continue lower than they are to reverse. It doesn't make any sense to try to pick the bottom. The Russell 2000, as we know, has also found buyers right at the volume weighted average price from COVID low, and that should be moved over just 1 week. And you can see that that's been the exact level 3 weeks ago. That's also the 38.2% retracement. It is not far-fetched to think that it could fill this in. Look at, here we have this prior resistance, and in here we saw 1, 2, 3, 4, 3.5 weeks of trading is all the price memory that's in there. So what that means is we've basically got a little bit of a hole. If it does something like this and creates some lower highs down to it, it's more likely to break, and I think you could see a quick flush down towards that 170-ish level. Biotechs have been a great example of this, that they're, supposedly down too much when they broke their volume weighted average price from the COVID low and the 38.2% retracement, but they came down to the 50%. They came down to and through the 61.8%. These are levels of interest to look for the potential that buyers are gaining control. But as we've noted over and over again, they're still below declining 20 and 50-day moving average, and they're still below declining 5-day moving average. In this week, they got above that 5-day moving average, but what was the direction of the 5-day moving average? It told you don't trust these rally attempts, and we're now back again below the volume weighted average price from the February 24th low. We're below this week's volume weighted average price, and we should actually, kind of put that on all of these markets. The S&P, that's the volume weighted average price from the recent low, and here it is for the Nasdaq. And you can see that today we broke down, rallied up to that, and then we got a second leg lower. Not a surprise. That's the path of least resistance. This is what markets and downtrends do. It's what they're supposed to do. They're in downtrends. You might not like it. It's not good for wealth creation, obviously. The financials, as I mentioned a couple weeks ago, I thought that they looked very similar to the Russell 2000 over in here, and that's what we're seeing happen, is that we're seeing it break down and play out maybe in a similar way. These things are broken. I would never want to have a penny in this stock in a chart that looks like this. It looks to me like they're headed much lower. The volume weighted average price from the COVID low eventually will probably hit at 32, but before we do that, maybe from this gap, you can see we've tested that already, and then from this test of the volume weighted average price was actually what we had tested. So we've got to go back and say, what's another important level? Well, that was an important peak right there. How about this important low? Are these going to be the important levels? They're only levels that will most likely provide a opportunity for a little bit of a bounce before the next leg lower. This is how markets work, and then come down towards that. That wouldn't surprise me one bit to see something along the lines of that emerge in the financials. Right now, they're stuck with a declining 5-day moving average below all these key volume weighted average price levels that I've mentioned, and there's just no reason to be long them unless you want to lose money. If you made too much money and you need to offset some gains, buying financial stocks right here is a great place to come up with those losses for the tax man. We've noted the energy names that the year-to-date volume-weighted average price was tested 3 weeks ago to the penny, and there were clearly buyers with programs waiting there for that to happen. they scooped in and have driven it higher once again. Energy just is not slowing down one bit. Be aware, where has it come from? Where does it have the potential to go? Well, this week we saw that it experienced a breakout. Oftentimes, breakouts, when they're extended like this, are a reason for some profit taking. So be aware that, there's still no signs that the sellers are getting aggressive in here. We're still above a rising 5-day moving average. But because of that breakout from an extended level, we've just rallied from 25 to 70. We've rallied 200% here in the last year. And now it's not breaking out. I mean, it broke out, but that's not a breakout that you buy. That's, uneducated money buying that breakout. They're most likely buying it from people who've purchased way down here and are saying, hey, those breakout guys are buying it. Let's sell some to them. The opportunities, I look at hundreds of stocks each and every single day on 6 different time frames. The opportunities are still clearly on the downside. We're short ATC at Alpha Trends right here. We got stopped out of URA. We purchased it at 25.02, sold a third at 25.92, got stopped out of a third here today and another third over here yesterday. So, we're out of that one. Doesn't mean we're not going to get back in, but, it's a little bit extended. Chewy is another short sale. Car is one that we're short. We got stopped out of a really nice short in GXO this week that we had shorted at $77.80 per share. And XPEV was another one we were short over in here as it's just starting to break down. And we're also short Ping, which still looks like it has PING, which still looks like it's maybe just beginning to get some downward momentum. There are a lot of names out there that still look vulnerable. Look at Kohu, look at AXON, look at CWH, look at EW and FLGT. Those are genetic stocks. Maybe that's the next fund they're going after that Kathy owns. HOLX looks like it's probably headed towards that COVID volume weighted average price. MXL is breaking down, and Nasdaq is breaking. NDAQ is breaking down here on this weekly chart. Looks like it has room to the volume weighted average price from the COVID low. Net, Cloudflare breaking down. SNPS breaking down as well. So the names are, I can come up with 100 more of these names because these are the patterns that look terrible. There are still some names. BTU looks like maybe it could do something next week. It's holding on to its gains well. That could continue nicely to the upside. Same with OIS. OIS here, the weekly chart on this oil states looks decent. TELL is another energy name that looks good. Valero, it looks like it's starting to finally maybe play some catch up in there. There's opportunities on both sides, mainly though on the short side.